Welcome everyone. Welcome Raman. Uh, really appreciate you taking time on a Wednesday evening to join us as a speaker on the Founders Talk webinar series. And all of you for joining the session on Founders Talk on a Wednesday evening, the audience. I really appreciate and it brings a lot of fulfillment because to invite someone like Raman and to put all of this together takes efforts. And if it doesn't have the right audience, then what's the purpose of doing this, right? So very quickly, my name is Darshan Doshi. I'm the founding director for the Center for Entrepreneurship and Innovation at Flame University. At Flame University, within the Center for Entrepreneurship, we run a startup accelerator program. It's called the Flame Origins program. So if you are a startup or you know someone who has revenues between 5 lakhs to a crore and is looking to grow their revenues or raise some investment, we've put together a program which is tuition free, equity free. You can go on the website and apply for that. We also run a student incubator program. It's called the Flame Incubator program. We have about 67 students going through this program as we speak. Of course, it's been online because of the COVID crisis and the lockdown. So it's not been to the level that I'd like it to be, but we are doing the best we can given the constraints that we have. And so if you're a student in any university, you can apply for this program, which will start in the next academic year. And then lastly, we've launched a 1-year postgraduate program in entrepreneurship and innovation. Now, this is for people who are saying, hey, I have an idea, but I have not worked on it. Can I give it a year to answer the following 3 questions? Am I the right person to build this business? At the end of the year, do I still want to build this business or grow my family business? And lastly, am I the right person to build this business? Right. So I think answering these 3 questions, if you can do that within a 12-month period, it's a good use of time and resources, which is what we've tried to bring in. And we've got partners with the likes of Campus Fund, TIE Pune, Babson College, amongst many others. So now that we have many more participants join us, let me now quickly introduce our speaker today. Let me just share very quickly the slide deck. So today we have with us a fellow TIE Charter member and one of the most prominent family advisors, Mr. Raman Nanda, and he's going to speak about managing family business for growth and for perpetuity, right? Just a quick overview, Raman has had an illustrious education and work experience. He's a gold medalist in BCom honors from Shri College of Commerce, that is Delhi University, followed by an MBA from IIM Ahmedabad. Worked with family-run small and large companies, startups, and established companies, and has lived in 9 cities across India. He has had experience with respected groups such as Murugappa, as well as the Tatas. He's been based out of Pune for nearly the last 24 years. So I can safely call him a Puneite or a Punekar. Yes. He started his professional life in finance, then went into plant constructions, led a business at Murugappa Group, and then head of HR and president for global business development at Tata's, and then served the country head and president in a large European multinational corporation. He's a certified executive and life coach, currently works as a consultant and coach to business owners and various CXOs. His strengths lie in giving trusted, confidential advice to family business owners on multiple and complex issues linked to business, family, and ownership. He also serves on the governing council of the TIE Pune chapter and mentors various startups. So clearly, folks, we have someone who's achieved a lot of success professionally, personally, and also understands enough about how to operate in a family business dynamic. Now, I come from a family business. I worked in the family business for 3-4 years, decided to move out of the group and start something of my own. And it's been an excellent journey, but very challenging in the early years of my professional career, when you have to, you have your family, you have relationships, you have business, you are trying to figure out who you are as a person. It can get very intimidating or confusing. So welcome, Raman. Help us clarify, what is family business? How do you grow family business? I read recently that there are many Japanese businesses which have been in existence for over 200 years, right? That's phenomenal. Some of the family businesses in India are over 100 years old.
Yeah.
So maybe would love to hear your thoughts. If you can walk us through a quick overview, that would be great.
Thank you.
Guys who are attending, you will see a Q&A box at the bottom. I'm sure you've used Zoom before in the last year. Please put in your thoughts, comments, suggestions, questions, and I'll bring them to Raman as well. We are going to have a good 20-30 minutes of Q&A session at the end. So please share it. Raman, all yours. Thank you.
Thank you, Darshan. Dear Darshan, Madhuri, and my dear participants for this webinar, a warm welcome from my side. It's an honor to be with you all today. Good evening to all of you. Let me start with a story. It's a story from Asia. It's not a story from Europe or the US, which are considered to be, very, very highly developed. But it's a story of a company called Kikkoman. And I think Darshan perhaps guessed it that I'm going to use that name, and he mentioned about it indirectly. So they are the world's largest shoyu producer. What is shoyu? It's a kind of soya sauce which is popular in Western Japan. But this company is now a $4 billion company and getting 60% of their revenue from exports out of Japan. By the way, the word Kikkoman means turtle shell. And turtles are mythologically supposed to be having a life of 10,000 years plus and are symbolic of happiness, longevity, and success. So this company's story goes back to the early 1600s. So you can well imagine that they are a 400-year-old company. And they started as a local soya producer in the city of Noda. But the Mogi and Takanashi families have run this company for over 17 generations. And even today, let me share my screen while I'm talking. And even today, one moment. The managing director of the company is one Mr. Mogi. So therefore, you can well imagine that this is something. Is my screen visible, Darshan?
Yes.
Okay.
If you could just make it full screen, please. Yeah, that works perfectly.
Okay. So, so this is a picture from their website. It's really one of those amazing Japanese art. But I think the question really is, what's their secret for being a company in business, a family business which is there for over 400 years? What's their secret sauce? I mean, to use a pun, for longevity, since they also are in the sauces business. So you can see here an ad from Kikkoman long back, and 17 generations have run this company, absolutely unbroken chain. So the secret for their success lies in their family principles. And there are 16 of these principles, which you will see on your screen one by one. I think the first article is very simple. All family members want peace. They want progress. They want perpetuation. So that's very clear. The family itself wants a perpetuation. It's not something that they are looking at a 1 or 2 generation kind of business. The second is keeping faith. That's equally important for a family which wants their business to be for perpetuity. The third is a very typical Japanese, you can say manners, where they are always polite to each other. And the important part is that the master is not polite, the others will not follow, and sin is the result of being impolite. The fourth one, I think, is the most important article out of the 16 articles. Virtue is the cause, fortune the effect. So many of us think that, what's the reason for the fortune of someone? It's not anything else but virtue. So this is something they really follow very, very carefully. The discipline and diligence is something I'll come to later to explain how it, plays such an important role in longevity, whether it's of our own life or whether it's any organization or even a country. Discipline and diligence are absolutely basic. Come to the sixth article, which is about people. Long before there were HR experts talking about this, I think the basic philosophy of the founders was very clear that people are important and you must put the right man in the right place. And that really brings, peace to their mind. The seventh is about education, and more importantly, it's about moral, intellectual, and physical education. Education of the children is the responsibility of the nation. Article 8 is absolutely fundamental. Approach all living beings with love. Words are the door to fortune and misfortune. A foul tongue hurts oneself. So many times in organizations, we find whether it's the CEO or others, they have a loose tongue, and that puts them and the organization into big trouble. Article 9 is about humility and diligence. Again, very, very clearly mentioned that you may be running a $4.5 billion company, which it is today, but they are insisting that they would like to be humble and diligent. Article 10, sometimes we in India can learn from that earning is from the labor of sweat. And of course, speculation and taking advantage of other people's weaknesses is something that we should avoid. Article 11 is talking about competition, which is very important, but we should avoid extreme or unreasonable competition. We have seen cases of, companies like in the telecom sector, which went for extreme competition and finally some of them, disappeared. Strive to prosper together with the public. That means the public is a stakeholder in the company. Article 12, absolute meritocracy. Make success or failure clear. Never fail to reward meritorious service and don't allow a mistake to go unpunished. Article 13, consultation. Don't do anything on your own. You got a team with you, the family members, take their inputs when you're starting a new business and also appreciate any profit made by your family members. Article 14, and I'll come to this later as well, avoid falling into debt, carelessly falling into debt, and don't guarantee others liability. You're not a bank. Don't lend money with the purpose of getting interest. That's not your business. You are in the business of making show you and not lending money. Article 15 is again linked to financial frugality. You must be frugal, save money from your earnings, give to society as much as you can. And Article 16 again comes back to consultation before taking a decision, which also helps the employees, be committed and be a part of the company. So for me, this is really the secret of the longevity of Kikkoman, where the Mogi family and the Takanashi families have been running this business for nearly 400 years. It's really amazing. I think you'll agree with that. It is really something to learn from a lot. Okay, let's come to what are the basic growth requirements. Here I will say a strong family business requires a strong family as well as a strong business. And that a strong business happens when there is growth. So let's look at what are the fundamental parameters of growth. The first thing is, of course, is excellence. It starts from the top, whether we are insisting on excellence in products, services, people, etc. I think as well as in the personal life of the family founder, the CEO, the seniors, is something which everyone else copies. The second is the customer focus and an infinite game, which Simon Sinek talks about, is really, that's the foundation based on which you can build any growth. There's no other way to have growth coming into your company on a continuous manner. The third is to be real, be realistic, smell the coffee, or as the Japanese call it, gemba, go to the spot. Don't take decisions in your ivory tower. See what's going on the shop floor or in the company or in the environment, and then take the calls. Many of us find that we are not seeing what the reality is. We are deciding on our strategy, our people, our tactics based on what we think is the reality, not knowing what it really is. So these are the basics. The fourth is the risk appetite. Of course, it's a question how much risk you take and whether you weigh in all the parameters and take a calculated risk. I mean, we have seen how the Aditya Birla Group has grown by very calculated risk taking, taking on acquisitions, sometimes which are bigger than the main company, but eventually being able to integrate them and move forward. So risk appetite is an important point for basic growth. uh, People ability is in terms of building your team, keeping the team together, keeping the team motivated. I think this is again something which cannot be overemphasized. And finally, as a founder, as the owner of a family business, if you want growth, you must learn how to let go. Without that, you are always ending up working long hours, as well as keeping the employees not so happy with what they are achieving and what they are doing. Let's look at the growth in the family context, because what I spoke earlier is growth in general. But in the family context, I think we have to see what is the different parts of the family looking at in terms of their aspirations. Are their personal visions aligned with the growth vision that the founder or the head of the family wants to have for the company? If they are not aligned, there is a problem. Second, you must be clear what kind of growth you're looking for. Is it in the top line? Is it in the bottom line? Is it in the valuation? Each one may not be the same and may have a requirement of a different strategy. The second is a sustainable growth. You know, there are shortcuts in business, there are compliance issues, there can be things that you do without looking at the long term. Those are things which really can affect the family business significantly. So, a strategy for sustainable growth is really important. Thirdly, there needs to be a balance between what is the growth aspiration, what is the really the situation in the organization, and the family. If the three are not having a balance, I think the equilibrium can get disturbed and you may not achieve what you set out to achieve. And finally, the growth cannot compromise the values, business performance, or governance. So, within this framework, we have to see how we can manage the growth. So, let's come to a very useful framework, which is the three horizon framework. McKinsey is the actually the author for this, where you can see on the x-axis, which is actually the time taken for each of the horizons to uh, come into being. So really, you have to see how much time it has to take to get an impact on the company. And on the y-axis is the value or profits that each of the horizons are going to generate for the company. I'll come into more detail for this in the next slide when I show you that what is the first horizon, what is the second horizon. I'm sorry. So if the first horizon is basically the existing products of the company, which is where the major profits and cash from the company is coming to the bottom line and top line of the company. And that's where, you can say it's the core business. You have to run it better than the others, and the metrics are normally the profit, the cash flow, the net present value, and so on. That's where the maximum management attention goes. Then comes the second horizon, which is emerging businesses that are going to provide you profits and top line for tomorrow. These could be opportunities which are still not crystallized, but they are on the horizon, say between 2 to 4 years or 3 to 5 years. That's the normal time period for which the second horizon is applicable. These could be areas where you have done trials, but you still don't have, let's say, a product ready for the market, but you have a plan to hit the market. So these are the horizons which are also competing for the focus of the CEO and the top management team. The third horizon is more really in the future, which could be some research projects or a pilot program or some small minority investment in a new company, which is a new technology, which again is something which may not yield in immediate result, but perhaps 5-7 years down the line, it could even be a collaboration with a university. So these are the three horizons on which the company has to focus. And when I talk about the family business, really you have to see here that the family must look at how the transition will happen from the current generation to the new generation over the second and third horizon. Often, the second and third horizon present opportunities where you can bring in the new generation because they understand the new technology better. Their thoughts and ideas are more likely to be applicable in the next 20, 30 years of the business than typically an owner who has spent the last 30 years in that business. So therefore, the second and third horizon are very clearly opportunities where we should look at, we meaning the family should look at bringing you can say the successors into the business and see that they try out, they run with a couple of ideas, they may fail in some, so that won't affect the main business of the company, but it creates a potential for a big pot of gold at the end of 5 or 10 years. An important point here is that often the younger generation has no problems with being in the business, but they do have a problem with the style of management which is followed by the current owner managers, which means they may have a way of looking at things which is very different. They may even like to have different working hours. They may like to have different ways of consulting. They may like to have different ways of going about what they are thinking. They may like to think global, whereas the current generation may have perhaps gone only for a local business for their success so far. So the style of management and the ability to integrate the newer generation, this is really an opportunity. So basically this three horizon framework is useful in allocating management time, in getting in the next generation, as well as allocating the investment which is available. The capital is always a constraint for any company. So this is a framework which helps you in allocating management time as well as investment over the next few years so that you are successful in this. So I hope this part is clear, and in any way, later on, you are most welcome to give your questions in the Q&A now or later. So let me come from the growth path to the perpetuity part. Now, this is where, if you saw the 16 principles of Kikkoman, I think they give you an idea that really there is something which is based on a lot of practical thoughts. So let me put the 5 pillars from my side on the slide. So the first is perpetuity mindset and psychology. The second is the right people in power. They're really important. Adaptation of the organization and the family, the future orientation, and finally the effective processes. So let me cover them one by one. So let's take up the first one, is the courage. Often the companies and the owners don't have the courage to look at a long period as the potential life of their company. There is the example of Dr. Anji Reddy, the founder of Dr. Reddy Labs, who met the owner of Merck, which is a 300-year plus organization from Germany. And learning from that, he set a target for his internal team that we must focus on building an organization for the next 500 years. Now, this is something which requires courage. And I'll explain that now itself, that often the courage required is because a decision which is good for the business sometimes may not be good for the family members. A family member may want to be CEO, but if you want to build a long-term business, it may be required in some cases that you have to hire the CEO from outside. So you need to have courage to think long-term. The next one is the founder's dilemma. The founder is the one who's really created the company, but often he or she will find that people in the family are not happy. So this is called the founder's dilemma, that whatever the founder does, and he's doing the best for a combination of what's good for the business and what's good for the family. And that's something which bugs the founders and affects the perpetuity mindset. The third area is optimization. Now, often we just focus on growth without thinking what is right. So it is not necessary always that we go for maximization. Sometimes we may go for optimization and not maximization, is what I want to say here. Similarly, the question of short-term and long-term focus is something where a balance must be struck by the management team. Too much short-term focus or too much long-term focus obviously has its own pitfalls. So I won't spend more time on this. Let's look at the next one. Uh, Most of the time, doing what you are doing currently is quite easy, but to do something for the future is risky. That's the courage, that's the psychology that the founder needs to have to be able to build for the future, allocate resources for Horizon 2 and 3, which is going to be the cash stream for the future. Frugality and liquidity is something which often get missed out. There is a famous saying, shirt sleeves to shirt sleeves in 3 generations for the business families or the family businesses, which is because the first generation sweats it, the second generation sweats and enjoys, and third generation only enjoys. It's not a generalization, but it happens often. So frugality and keeping liquidity in the company, in the families, is really important to survive. Debt leverage can kill and has killed many companies. So this is an important principle for longevity. This is something I covered earlier, committed employees. I think ability of companies and owners to build a committed team is a difference between what can happen and what they want it to happen. Finally, purpose driven or being a force for good, a North Star where everyone is aligned is something which takes us more and more towards perpetuity. Like the, the motto of the Kikkoman group is to have seasonings, for all kinds of requirements. So you must have a purpose, and that's something which binds everyone. Now, this is, you may have all the psychology for perpetuity, but if you don't have the right CEO and the right board, you can achieve nothing. It's very simple that you have to be right in this. And there's something that companies often spend a lot of time in finding the right CEO or finding the CEO when the owner wants to hand over to someone, or he needs, there's no one from the family, or there's someone from the family who's not good enough in his view. You have to find the right person in the CEO position. Without that, there's nothing we can do about perpetuity or about growth. The second is the a functional board. So if you have a bad or a non-functional board, you can be rest assured that you will be having decisions taken based on sometimes political reasons, or sometimes the board is quiet, is not able to stand up to the CEO to smell the coffee or to do what's the right thing to do. So these are absolutely crucial, and you can say these are go no go kind of requirements. Linked to that is that whenever you're entering a new business or market, there is often a tendency to send a trusted person from in-house to look at that business. It's always good to look at that person, but also compare with what you can get from someone who's already in that business and he has a track record which is really good. It's important that that decision is taken absolutely knowing that that would change the fortune of the company for a long time to come. I think this slide is really crucial in terms of what's going on. So I think we all know that to survive, you have to constantly give up businesses, add businesses. So I'm saying that the churn is on. Uh, Second is to be entrepreneurial. If the founder is focused on perpetuity, he has to constantly be seizing opportunities, looking at opportunities, meeting customers, finding out what's going on, and seeing that they don't miss out opportunities which can really become the base for Horizon 2 and 3 for the future. There will be ups and downs in business, but we have to keep moving. Before Alan Mulally took over Ford Corporation, it had a loss of $17 billion, and he converted that into a huge profit over the next few years. But it's possible that they had not got Alan Mulally and they would have been still struggling. But you have to keep trying, you have to keep moving and not get stuck with some decision which you have taken which is not perhaps correct. This is the most difficult. When the environment changes, please remember whatever made you successful, we must give that up. This is really hard, and this is something which, if adaptation calls for it, the one which is most important and most difficult to do. Uh, we know that we are used to, as human beings, to go for what we did last year, what we did, year before last. So you look at your product portfolio, you look at your geographical spread, you look at what businesses you are in, what technologies you have, what business models you follow. If you cannot keep changing them, reviewing them every now and then, uh, I'm saying calling it avoid sameness. This is something which will take you to do what is relevant now rather than what was relevant last year or the year before. Sometimes the company gets stuck or the organization gets stuck with a family member, may not be necessarily CEO, but in a position which is crucial, but he or she is not performing. These are dilemmas which often hold the family back, and you have to always take a call that you are trying to build a growth and perpetual business. So you may have to do what is right for the business and not what is seen as fair or unfair by the family members. Uh, Obsolescence is a fact of life. What is important here is you need to even look at your people who may have joined you 10, 20 years back, but they have not reskilled, they have not changed themselves to be relevant and to be effective in today's world. You need to see what's going to happen for them and take whatever is required so that your business doesn't suffer. This is the most difficult part, that you have to predict your own decline. You have to predict what worked for you and what is not likely to work for you. And for this, very often, the best way to do is to get outside experts to review your strategy, to review your business models, to review what you are doing, knowledgeable experts who will absolutely tear everything to find out whether it's right or wrong, and you take action based on that to give up your comfort areas and to do what's required. Let me move to the fourth point, which is the focus on future. So I think here it's really important. To build the future means looking at new products, new services, meeting new customers, seeing new areas, allocating resources for horizon 2 and 3, and building the future. There's no other option. If the company is not focused on that, it really is not going to change. Equally important is talking about the future. If you go to any company, the first presentation is about the last 10, 15, 20 years. There are not many presentations which start with talking about, what's going to happen next year, next 5 years, next 10 years. We have to push. The founder, the CEO has to push that there is a focus on the future, not only building, but talking about the future. And finally, you must have someone to see outside in. We are all good at seeing inside out, but seeing outside in and seeing what the reality is and facing it is what I call focusing on the future and trying to ensure your survival. The last part in this is the processes. I think the processes are the base of any company. I think we all know that. So the first part is, of course, separating ownership and management. Uh, it's possible that the founder is wearing both the hats of the owner and the manager, but he must know when to give up the wrong hat and when to wear the right hat. If he mixes up the hats, that he takes business decisions which are good for the family and bad for the business, surely it's not a great process that is being followed. So separating ownership and management is really important. The second is governance, which is listening to all stakeholders and ensuring that there are structured dialogues happening with them. So you take their points of view into account, whether it's the environment, whether it's diversity and inclusion, all those are part of governance. The third is uh, having advisors who are, you know, is this, sorry, yeah, knowledgeable advisors. I mentioned about it briefly earlier. Let me say, every needs apolitical, objective, knowledgeable advisors. You cannot do it alone. There's a lot happening in the world. Obviously, you have to be able to afford it, but the cost of not affording it is even higher. So having knowledgeable advisors around you in your advisory board, in your main board is really crucial. That's something which helps you to retain a chance of managing to get perpetuity on your side. And finally, a functioning board. And by this, I mean, the founder during his or her lifetime must build a board which is functioning, which can stand up to the founder, which can say what is right, which can take the right decisions of CEO selection or any other selection of new product line, strategy, etc. So a functioning board is the least that the founder owner should leave during his lifetime, because that's something which will keep the company going. So continuing with the processes, you need the same sort of situation in family processes, a family council where all family members are heard regularly, all family members contribute to the business by giving their ideas, but at the same time, there is a wall between family interference in the business. So family processes are really important in a family business. It need not be repeated. Talking about family splits, of course, the objective is as far as possible avoid the splits. But even if it happens, that's fine. I mean, we have seen businesses like, the Birla business had so many sons and grandsons. Uh, Now, one of them, the Aditya Birla Group, now led by Kumar Mangalam Birla, has really taken off. And in spite of the split, in spite of being separate from many other Birlas, they are really going places. Or even if you take the case of Mukesh Ambani, how he has built the company in spite of the two brothers getting perhaps what their parents thought was equal in terms of their legacy at the time of the split. But look at the way that one of the family members, in spite of the split, has taken the family places. Uh, Coming to the next point is that often the parents or the founders don't make things clear. So always one of the best processes is to not to leave the issues to the children, decide them, have a will, have a suggestion, have a board which can take over in your absence, but don't leave the issues to the children. That's not something which will help you in perpetuity. And finally, I think even if the owners are not running the company in terms of active management, the shareholders need training. And that's really important. And that's something which the Merck family in Germany, which I said is more than a 300-year-old company, they do that for their shareholders. So with that, let me come to a summary of what I shared today. As I said, it starts with personal excellence and philosophy of the founder and the board. Target of perpetuity has to be specifically chosen. It's not by default. It's something you have to choose and work on it. The second, as I said, the saying is that only 30% of the family businesses survive, after the first generation, 13 after the second, and 3% after the third. It is possible to break that jinx. Even the 3% who survive are really, like you take the case of Tata's or Murugappas, they are surviving and thriving, so it is possible to break this jinx, which is, really well known. Uh, you need to be obsessed with longevity and decisions based on the long term, being purpose driven, and of course, you have to be a force for good. Other things sooner or later will get washed away because they are not really perpetual. Your team and their team and their teams and the culture of the organization is so important. I can't overemphasize that. That's something which requires a real focus. And finally, it is said that you must deliver more value to every shareholder, and only then you earn a license to serve the society and to longevity and potentially perpetuity. So let me show this in mathematical terms for some people here who may be having a technical bent of mind. So I say perpetuity is equal to vision plus values into goals plus plans and even processes, and the whole thing into discipline. So the important thing here is in any of them, if you are less than 1, for example, 0.9 into 0.9 into 0.9 becomes only 0.72. So, your chances of perpetuity come down if any of these things is weak. So, to explain in a little bit more detail, the values is what takes you, the vision is your guiding light, and that's the first part. The second is the goals, plans, and processes. Having smart goals or smarter goals with emotion and relationships, because we are in a family business. So emotion and relationships are also important, but let's not forget the processes. And finally, the discipline and the proper review system is what takes you. So this is a depiction in mathematical terms for some of my mathematically inclined participants today. Well, that's it from my side to start with. So Darshan, over to you, and I'll stop sharing
Yeah,
for the
sure.
moment.
Absolutely awesome, Raman. That was very, very insightful indeed. There's a popular saying: the first generation builds it, second generation grows it, third generation blows it. And we have a question as well over here by Pradnya, about the 30, 13, and 3. We have a lot of second generation and third generation family business owners in the 1-year postgraduate program in entrepreneurship and innovation at Freedom University. And consistently, these are the two themes that at least I have seen whoever are applying or participating in the 1-year PGPEI program. That is, I want to continue and grow the family business, or I want to continue under the umbrella of family business, but want to start something of my own, using the resources, the capital, the goodwill, the network, all of that, right? So maybe some thoughts around this whole transitioning, because
Sure.
I don't know the stats, but there is a feeling that, in India, you have a massive challenge, at least on transitioning across generations. So maybe some thoughts on that.
Sure, sure. First of all, Pradnya, I think the jinx is very clear that 30% of the family businesses survive, the founder's generation, the first generation. 13% survive the second generation. That means the children who become the like siblings who may run the business, and only 3% survive the third generation. So I hope that part is clear. Is that making sense to you? You can let me know, but in case it's not clear, I can explain more. Now, I think Darshan raised a very valid point in terms of transition. So it's difficult to generalize, but I would normally say two things. A, there is typically a lack of dialogue or sufficient dialogue between the two generations. And I mean, what to say, even in my own house, I would say I'm not fully aligned with what my kids are thinking. I mean, we don't have a family business, but I'm saying it is what it is. So there is a difference in their perspective of savings, of their aspirations, and so on and so forth. So the dialogue in a family business is really crucial. And the way to look at it is that if the children have more respect for what the founder or the parent has achieved, that parent has achieved with a lot of blood, sweat, and tears over 20, 30, 40 years. And there is a lot of wisdom to be gained from that parent. So that's the first part. So if you appreciate that and you're willing to, sit at the feet of the father, I'm saying in metaphorical terms, not necessarily physically, but you be in a mood to listen and understand his stories, what he did, where he succeeded, where he failed, why he failed. So you are getting a ready-made, absolute encyclopedia of situations which help you build your own internal operating software. So this is without going to a B school. And I can tell you with due respect to Darshan that what you can learn at your father's feet sometimes may be even more crucial or valuable than what you may learn in a B school. So that's point one. The second point is for the parents equally, there is a struggle. They don't understand the new generation. And that's because we are always trying to force fit our ideas onto them. It's not possible. It won't work. So if you push that generation to absolutely in an ironclad kind of framework, say you must do this, you must get up at 5 a.m., I go for a walk every day, you must join me, etc. So they may have different timings, they may have different interests. What is important is you must respect that there are differences, A, and B, you must respect that their talent and skills are likely to be far more relevant for the next 20, 30, 40 years. So, if you give them, like I mentioned in my presentation, there's an issue of style. There's a serious issue of style. So, if you are willing to compromise on style, and the right word is not compromise, you can say you adapt, you accept, you tolerate, whatever. I think there is a far greater synergy which is possible where the next generation may be a part of the same business, maybe not really reporting day to day. They have some freedom. They have been given X amount as capital and they have to prove something. They may make some mistakes. So, therefore, you may not put the entire capital of your company at risk by giving them, but you give them exposure in doing something on their own and make them feel confident and proud and so on. So, these are some thoughts, Darshan. I hope I have answered your question.
Awesome. Yeah, I mean, we've got a lot more questions coming through. Here's a question by B. Padmanabhan. Doing business in India is tough. I was part of the family business, which was in fertilizers and engineering for about 3-4 years. And, it's significantly different to work in India than other parts of the world, especially the Western parts of the world.
Yeah.
So his question is, in Indian conditions, good value system is a casualty in many family-owned enterprises. Though there may be short-term gain achieved through compromise on values, it will destroy the enterprise in the long run. So what are your suggestions, some thoughts, given the fact that, look, before 1991, it was license controlled.
Yes.
Right. After 1991, India kind of allowed, or businesses were allowed to work in a better framework, so to say. So maybe some thoughts around that.
Yeah. So, Padmanabhan, it's a great question. I appreciate that. I have to say that there are two parts to it. One is there's an organizational ethos. Say, I worked in Tata Group for 11 years. You were also there. So, it was quite clear what are the do's and don'ts. In some of the other companies, and it's not necessarily family businesses that may have shortcuts or that may not have compliances. I think it's the disease is actually all pervasive. So I don't want to say it's there more in family companies, less elsewhere. I think we all know that despite the license Raj going, still there is a huge discretion which the bureaucracy or the political masters have. To my mind, it is a specific organization and that person's decision, what they are comfortable with living with. I would say, by and large, it's worth paying the price of some delays. It's worth paying the price of some inconvenience, but spreading the message in the market that we are a company that wants to live by ethics. We are, we will do the right thing, and let's see how long you can delay it. Gradually, that spreads and your reputation becomes stronger. It's very hard to implement it. I am saying that, but it's a call which each company and each person both have to take. It's possible that the company may allow someone to, let me say, take care of someone else, but the manager concerned may say, no, 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 I'm going to play by the rule book and I'm not going to go out of the way. So I'm saying it's a very specific decision that both have to take. I'm afraid very difficult to give general guidelines. I would always say struggle for the short term, it's good for the long term.
Great, fantastic answer. Here's a question by Rajiv Inamdar. Given that the CEOs of privately held family business owned businesses don't have the same pressures as the publicly listed companies, quarter by quarter announcements and the short term results that they need to maintain for the stock prices. Is it fair to say that these family owned businesses are more focused on thinking about investing for the future? And do you have some Indian examples?
I would say, first of all, hi Rajiv, thank you for the question. Definitely, one of the big pluses of a family business is the agility. You can take much faster decisions because you can get the family members together, you can get their views and move faster if you have to. Whereas in publicly listed companies, you may have challenges of ensuring that all the processes, all the governance processes that need to be done are, have to be, all the boxes have to be ticked and so on. So I would say family businesses will be by and large more nimble and able to take faster decisions. But sometimes faster decision may not be the best decision. So I don't know whether it always will be helpful. But if you are in a listed company, I guess the Wall Street or the Dalal Street pressures are something that you willingly signed up for that. And there are people, I have seen, you heard of HDFC Bank chairman Aditya Puri. There was not a paper on his desk whenever anyone met him, and he was always out of the office by 5:30 or 6. So even public listed companies CEOs can have a style by which they're able to manage very well, and let me say, manage the stress. I'm not saying he didn't have stress. Manage the stress and still be pretty much like anyone else. Darshan, did I miss any part of Rajiv's question?
No, I think that's perfect. The other question comes from Dhirendra Chaudhary, right? Could you shed some light on training the shareholders, whether it's the founder, CEO perspective, or any other perspective? I mean, personally, my own family business, two sets of businesses, two sets of families. We decided to separate back in 2015, and that was facilitated by a really good professional who helped us through that process, right? So I've seen a lot of value and benefit in it, but would love to get your thoughts, because you also mentioned dialogue is very, very important.
Yep.
So maybe you could shed some light on the training of the various shareholders.
Yeah, many of the family members who are owners uh, become owners, by virtue of the succession, and all parts of the family are not necessarily involved in the business. So many of them may not know the nuances of the commercial world or the nuances of how to manage their investments. So it's really important that they buy into the vision of the company, they buy into whatever is happening on the in the long term. They get involved in the family council meetings where they understand what is happening. So training of the shareholders is not necessarily by outsiders only, it is also by the founder, by having a continuous dialogue explaining what is happening in the business and why they're entering a new line of business, what are the risks, what are the positive things, and so on. So the idea is that even though the shareholding has got fragmented, and in the case of Merck, with the 300-year-old legacy, you can well imagine that the shareholding could be in maybe 0.5%, 1%, quarter percent with many of the family members. So keeping them aligned, keeping them involved, keeping them committed, and also having faith in the long-term future of the company is part of that training. So training is onto how to manage their own financial, personal life, and so on. And second is on explaining what's happening in the company in terms of financials.
So this is a great question by Sumit Bansal. What should be the typical position and starting point for the next generation family member to join the family business?
So I always recommend two points in this. One is that I always recommend, even though that's not part of the question, that you must spend 2-3 years at least outside before joining your family business. So Sumit, sorry you didn't ask that, but I'm saying that it is almost like a given these days, because once you're in the family business, you can't go out and learn that. So that time will never come back to you. So you must spend 2-3 years. And I know families where they insist that within that 3 to 5 years, not 2-3 years, you must get at least one promotion And that's written in their family constitution, that's like a basic requisite or a prerequisite for entering into the company. So that's part one. Part two of your question is the real question, and I would say always it has to be in the area which is the most crucial to the company. For example, if it's a manufacturing company, please join on the shop floor. Don't join in finance. Don't join in corporate planning. It's a very, it won't give you the understanding of what is it that the company is doing. So get into the heart of what the company is doing and have an attitude of learning, for at least for the first few years, and then gradually move up. So start at the bottom, start in what is most crucial and often sometimes the dirtiest part of the company.
If I can just build on that,
Yeah, please.
so when I was growing up, and this is pretty common in various Gujaratis and Marwadi families, is that your childhood, you are exposed to a lot of business acumen from the elders, right? So you develop a lot of business acumen as you're growing up, which is great, especially during summer vacations, winter vacations. And I love the idea and completely agree with you. I would actually say, give 5 years, you have to work outside,
Yeah.
learn how to be a thorough professional, understand what it is to earn money on your own.
Yes.
And then lastly, what I would also say is, once the person comes into the family business, uh, make sure how do you remain humble without the entitlement.
Yes.
I think that is one part where hierarchical approach, even though written it might be at the shop floor, how do you actually treat the person at the shop floor in a professional manner,
Yes.
keeping relationship aside, right? I think that is extremely, extremely important actually.
Agree. Completely agree.
So we'll take one last question. And this is Alpana. Great discussion today. Family businesses suffer from tech advances. How do you tackle that? Have you come across that? And does outside consultation help in such a scenario?
Yeah, absolutely, Alpana. I think the world is so dynamic today. There are so many options for technology available. You have experts available on per hour basis on so many websites, whether it's GLG or Link or GuidePoint. There are many, many options available. So don't shy away from technology. Don't shy away or don't get awed by the big daddies of any business. There are always enough niches where you can find the appropriate technology if you search for it. And depending on the company you are in or the industry you are in, you may have a small R&D team so that you understand what's going on for doing adaptations, something which the customer needs, which you can do much faster than those big companies where there'll be 20 processes for approval of a free sample. You can give free sample to a customer, which is 70-80% of what the big company can give. But you are beating them by speed. You may not have, as I said, the most, the ideal, most optimum solution, but you'll beat them on speed, on customer relationship. So coming back to your question, you can do it. Don't get awed by it. There are many ways to do it, and I'm happy to spend time with you offline to spend a few minutes or half an hour, any time that you want to answer you more. Back to you, Darshan.
Okay, we'll take one more. But before that, Sanjay Dave is asking if the presentation can
Sure,
be
sure.
shared.
Yes, yeah,
Yeah,
sure.
so we'll do that. Thank you. Here's one last question from TS. Sometimes the kids may study something new of their interest and aptitude, but may want to be a part of the existing business only as a shareholder or minimum management intervention, while building their own startups. So basically, as I understand from TS, the family business is going on, let it continue, let me be a part owner of it, but let me do my own thing. And that's fair, right? But how do you implement something like that?
No, it's very easy. It's not a problem. You be on the board. You can be the chairman of the board, supposing the founder is gone, or during the time of the founder and you can be on the board. So the board is meeting quarterly. The board is setting direction for the company, but a board member need not be spending time in running the business. So you can be a board member. You can be an investor because you hold the shareholding by virtue of the family, but you don't have to be running the day-to-day operations. That's fine. I mean, if Tendulkar had been born in the family of an oil mill owner, it's possible that nothing wrong with oil mill or cricket, but I'm just saying the interests may be very far apart. So you run your own business, but you can be on the board for oversight of the CEO and his team, so that they know there is someone watching, there's someone measuring their performance, because you need every stage a check and balance in any organization. So you'll be that check and balance. So nothing wrong with it.
Great. There's so much more that we could talk about. Raman, this is such an excellent topic and it's been a beautiful session. I hope we can get you back, not only as a visiting faculty member at the one-year postgraduate program in entrepreneurship and innovation, but also advising us and conducting more such sessions for our audiences.
My pleasure.
So, thank you all for joining us today, this evening. Very quickly, let me just share my screen and say what's kind of coming up next. Next.
Before you finish, I want to just show one slide, if you allow me to.
Sure, absolutely.
So I just want to show one slide. So sorry, the last slide. So which is sorry. So this is the slide which I wanted to show last to you guys, which is that you must leave a legacy. So that's what for me is the definition of perpetuity. So legacy is a fundamental part of life. It's not something which you're doing for yourself, but for the next generation. And I believe it really gives meaning to life. So that's it, Darshan, from my side. I just wanted to show this one slide.
Thank you, Raman. Perpetuity is a big word. It's a heavy word, but you've given a lot of meaning to it. So thank you for joining us this evening. Next Wednesday, we've invited Narayan Muralidharan. I've known him for a few years. He heads investments for Patni Family Office. So how do family offices look at investing in startups, in companies, in private equity, and the other, asset classes? So, you can join in next Wednesday from 5 p.m. to 6 p.m. And Narayanan is an absolutely amazing speaker, just like we've had Raman today. Again, Raman, a power pack session. I thoroughly enjoyed this session. I hope all the audience members have got the benefit of it. For those who are joining us for the first time, you can go on Founders Talk on the Flame University YouTube channel, and we've got great speakers previously whose recordings are available on the YouTube channel. People like Sanjay Mehta, Amay Mashilkar from Geogen Next, Sanjay Mehta, who's one of the most prominent investors. We've had Ajay Bhagwat, who's the founder of Renu Electronics. So we've had some fantastic speakers, which we've got the YouTube channel on, and you can take a look at those. If there are any particular speakers that you would like us to invite, drop me a note. I'm at darshan.doshi@flame.edu.in. You'll find my details on Flame University's website. Reach out to me, and I'll do what I can to invite people on this Founders Talk webinar series. We just want to be useful, and this technology allows us to do that. So Raman, thanks a lot for joining on this evening. Hopefully we can get your insights going forward as well.
And the audience for being so attentive and asking the questions. So big thank you to them as well.
Thank you. All right, everybody, stay safe, and we'll see you next Wednesday at 5 p.m. Take care.
Bye-bye.